welcome to Venture and Capital. Today's session is Trends in Cryptocurrencies and Digital Assets and Understanding the Network Effect and the Exponential Opportunity in this space. I'm John Dean. I'm the CEO of TCM Capital. I'm also the CEO of a company called Trovio, which is a technology company in blockchain. And I sit on the Digital Finance CRC board, which is a government-funded research institute into all things around digital economy. We might go around the room and maybe I'll pass first to Daniel to introduce himself and then we'll kick off the session.
Yeah, hi everyone. I'm Dan Pickering from Listed Reserve. We run a managed fund. We've been investing in digital assets since about 2018. We've returned about 600% to investors since then. So interested to catch up with everybody about what we're doing and how we're doing it and what's going on in the space at the moment.
Thanks, Daniel. Maybe Jeff?
Hey guys, so I'm Jeff Yu. So I'm CEO and founder of Monochrome Asset Management. So we are a managed Bitcoin fund in Australia, offering that convenient and regulated and secure access to digital assets for wholesale investors like you. Most people know me as the former CEO and co-founder of Binance Australia, which is Australia's largest and most liquid digital asset exchange. I'm also a very passionate advocate of digital assets in Australia for many years now, since I heard about Bitcoin in 2013.
Great. Thanks a lot, Jeff. Hendrik?
Hi, everyone. I'm Henrik Andersson. I'm the CIO of Apollo Capital. Apollo Capital is one of the longest running crypto funds in Australia. We are running two strategies, one long crypto fund, where we have had a strong focus on DeFi. We've been one of the pioneers when it comes to DeFi investing, and we're also running a market neutral strategy at Apollo.
Great, thanks, Hendrik. And Yael?
Hi everyone, I'm Yael Tamar. I'm the co-CEO, co-founder of SolidBlock. So we specialize in digital securities that are backed by property. We work with DeFi companies and provide a platform to collateralize real world assets and have access to the DeFi world, and also a place where crypto investors and crypto funds can place some of the investments in a more secure, in a more I would say stable environment with a stable asset class behind it, if there is such a need. So I come from a financial world, from Wall Street and then M&A private equity world. Going into blockchain with that background and working in the real estate industry.
That's great. And maybe that's a good way to start, Yael. I mean, obviously you're in this space, you come from the traditional background. Could you maybe elaborate on tokenization and what you think the future of tokenization is for businesses, I guess the real world application?
So that's a great question, John, because everybody's asking when are we going to see this space soar like it was predicted in 2018, then 2018, 2020 again, right? So what's preventing the tokenization from really becoming the norm? On the other hand, there are many assets that are tokenized on the back end, and you don't hear about it. They're not available to the public, but most of it, most of these assets are actually bought by funds, right? In private transactions, so the main benefits of tokenization is, of course, liquidity. So we do need to see liquidity in the market. On the other hand, exchanges and the secondary market players are not ready to start trading securities, right? So we have obviously largest exchanges, like Coinbase and Binance that need to step up and join the game, right? But on the other hand, it's risky because there is a lot of regulation, and it possibly is not as profitable as doing that for crypto assets that are much more easily traded, right? Digital assets that are more traditional, like funds and crypto. So in my estimate, tokenization is going to take a little bit of time. And I think this year and possibly 2022, when all of the big exchanges are going to finalize their regulation, processes to get the secondary market going, that's when we're going to see everybody jumping on board. That's the question on all of our clients' mind. That's the first question. Do you see liquidity in the secondary market? I actually would like to hear possibly from Jeff what he thinks about that.
Thanks, Yael. Yeah, I do agree that you need the whole industry to really keep on par with the services that we want to sort of see mature. Obviously the liquidity on DeFi, liquidity on the spot market, and even the futures market for the top digital assets have been significantly improved over the past cycle. When we say cycle, we mean like every 4 years, referencing to the halving. So it is definitely still a nascent industry, but what I would like to see is more industry participants offering various support as a whole sector. I'm a big proponent for regulatory clarity. I think that will help, not just for more operators to step up in the space to offer more services, more high standards of services, but also for investor clarity for them to be comfortable entering this space.
On that space, I mean, you talk about regulation. Which asset class, maybe back to you, Yael, but do you think will go first in regards to like sort of mass adoption from a tokenization standpoint? Like you could look at real estate, the St. Regis, obviously in Aspen, which was like a tokenization project a couple of years ago. What are you seeing, and where do you see the growth?
So we were the technical partner on the Aspen deal, right? So we technically did the first smart contract in the industry. And, real estate is a prime candidate, but surprisingly, what I'm thinking is going to go much faster is the metaverse, and possibly real estate in the metaverse, just because, most of the crypto industry and the gaming industry intersect. And the gaming industry is huge, and it's very fast in adoption of new technologies, much more the traditional real estate world. So it might be funny, but I think that this market is going to grow really, really fast. But then there's also a lot of players from oil and gas industry, and the reason why that industry is a prime candidate is because of the taxation benefits to private companies, right? And actually, that's what might be driving tokenization industry in the long term, is that some companies just don't want to go public. So, and tokenization offers them an opportunity to be private and tradable.
Yeah, okay, very interesting. Daniel, you've called for greater regulation in cryptocurrency. And, there's obviously been quite a few different inquiries. Senator Bragg's been doing quite a lot in this space. How do you think regulation plays out in crypto, and why do you see it as a major beneficiary to the space?
Well, I think particularly for institutions, I think people are really looking for clarity, right? So where do they stand as far as the asset class is concerned? And you need to kill off the fear that the whole thing's going to be banned. And I think, if you look at Australia, most recently, the announcements from ASIC around the requirements that we're going to have to, the hurdles we're going to have to jump over to get a Bitcoin ETF live, for example. I think they were very sensible, right? They weren't asking for anything that you could reasonably deny an investor. So I thought, their suggestions were perfectly reasonable, and they thought about it quite hard. I think contrast that with what happened in America a couple of weeks ago. You're tagging legislation on the back of other legislation. They were asking for things that weren't reasonable, that weren't well thought out. And I think, if we get sensible regulation, then we're going to get sensible products quite quickly. And the first sensible product in my mind would be a Bitcoin ETF. I mean, I see that happening in Australia probably next year, perhaps before America jumps. But I think the Americans are really, certainly Gensler at the SEC is embarrassed really that they're behind the curve on it all. The Canadians have got an ETF. Why don't the Americans? And clearly there's a demand in the market for it. So to answer your question specifically, I think the first thing that will benefit will be Bitcoin. I think there'll be other assets that perhaps struggle in the short term, particularly those that are classified by the SEC as securities. I think, you're going to find a bit of pain across the asset class for, some of the sector. Other parts of the sector might do better in the short term. But, it's about clarity, really. I mean, no one really wants reams and reams of regulation, but people want to know where they stand before they hand over their money. And I think that's fair enough.
Yeah, maybe that's a good lead in into sort of the institutional space. You mentioned that a couple of times in your response there. Like, do you think institutions can play all the way down the curve in crypto, or is it going to be a case-by-case basis? Like, if they start regulating Bitcoin like the CFTC did as a commodity, is Bitcoin then going to be part of their portfolio, or is it all encompassing and you can grab, it's more based on market cap?
Well, I think you would look to Bitcoin first, because we can be, fairly comfortable in most jurisdictions that it isn't classified as a security, and that makes life a lot easier for everyone. So I think Bitcoin moves first. Are they going to go diving into altcoin number 994? No, they aren't. And I think, over time, you'll see them extend their wings into DeFi and other options. But I think it'll be the major assets that benefit first. And probably Bitcoin and Ethereum will lead the way. It may be years before, and by years, I mean 3 to 5 years before they're really getting involved, further down the food chain.
Yeah, okay. Maybe that's a good segue to you, Henrik. You've got one of the best performing funds in Australia in crypto. I know you're quite active in the DeFi side of things. How do you consider your fund, one, at the institutional level, given that sort of comment from Daniel, but then two, when you're looking at returns and sort of how you allocate risk?
Yeah, sure. I mean, I agree with Dan, right? So institutions, they will first look to Bitcoin, right? And I think, these days, many institutions, are starting to get their heads around Bitcoin, and there are futures, traded on regulated markets like CME, right, on Bitcoin, where institutional investors can get that access. I think increasingly this year, institutional investors are starting to recognize Ethereum as an alternative asset as well, and an asset that offers something different than Bitcoin. So in Ethereum, we have kind of that real utility use is like this powering this new infrastructure, financial infrastructure that is DeFi, decentralized finance. I think that is becoming quite recognized increasingly among institutions. So I think Ethereum is increasingly becoming an asset that is recognized among institutional type of investors. And so I think is DeFi. So we have seen, for example, a number of call them traditional venture capitalists or private equity firms starting to invest directly in tokens, in DeFi tokens. And obviously that is attractive because we are seeing that enormous growth in the DeFi space. By some metrics, the DeFi usage or utility have increased by around 100x in the past 18 months when I look at the activity across DEXs and the lending space, etc. So I think there's increased focus on that. And then, like was touched on before as well, the NFT space that is increasing in pace as well, and you're seeing a lot of sort of people from retail interest in the NFT space, and that can really bring in a lot of people into crypto through gaming, through collectible and digital arts.
On the NFT side, do you see there's a big investment opportunity there for people on this call, or is the play more on Ethereum when you look at things like NFTs?
Yeah, that's right. So Ethereum is the biggest infrastructure for NFTs. So it's a little bit harder, I think, to find these kind of specific infrastructure investments perhaps around NFTs, but most of the NFT activity is happening on top of Ethereum.
Yeah, okay. And then how do you, this is maybe a question for everybody, but when you look at things like DeFi and coming back to the regulation question, and obviously DEXs and the fact that, from a KYC AML standpoint, how do you see that developing over the next really 6 to 18 months? Because obviously the application of the technology is fantastic. And when you took what Yael's doing on real world tokenization, it could be applied across many different assets. How do you think that will play out?
Yeah, that's obviously a really interesting question. And we have seen some debate around it with the infrastructure bill that was discussed on this call as well, where kind of you put a regulation in place that might not be DeFi protocols or non-custodial services might not be able to comply with, right? So that could potentially pose a problem, especially in the States, if that regulation is going to take effect. But what you might have to see in this instance is that you have unstoppable software running on blockchains like Ethereum, and I think what we have seen so far is that you have perhaps geo blocks. So maybe there is a Uniswap front end that is not available in the US, or you have censorship, on certain front ends to those kind of dApps. So that could be one way forward, I think.
Do you want to add anything on that? Yeah.
Yeah, I believe that NFTs right now are a temporary solution to the regulation issue, because the regulation hasn't caught up with NFTs. And there are a lot of securities that are passed for this new animal called NFT, and the market is booming precisely for that reason. So it kind of reminds me of the ICO era. On the other hand, the standard itself, NFT, has a lot of promise, and I think is a great way to indeed sell and market most assets, especially those that are difficult to track or difficult to sell. Even real estate, right? So apartments, for example, buying real estate abroad is a cumbersome process. So you can solve a lot of these things with NFTs, and I believe that will happen. Now, there are some use cases for NFTs that really are going under the roof of the utility token, and that's fantastic. So in real estate, for example, timeshare. Staying in hotels, right? And it could really revive the hospitality industry, have people order rooms in advance, or experiences, or tickets. This could really go well, especially you can probably kind of speculate on which places in the world will bounce first, which places in the world will become really hot, so NFT could really be useful. On the other hand, in the United States, if you do want to issue a utility token, you have to get registered. You have to get it registered. So there are other places, of course, outside the US where NFTs will play an enormous role, and when used correctly, as a non-security, could be a huge market connecting real-world assets to digital. And now, again, the same things could be applied to metaverse, right? The rights to use certain assets or certain attributes or characters or whatever. So my prediction is that NFT is going to go through the roof in the metaverse, in the gaming world, and follow as it normally does, quite a little slower in the traditional world. But I think NFTs are definitely here to stay.
Yeah, maybe that's a good sort of transition then into the other sort of, I guess, hot topic in crypto, which is ESG. Obviously, Elon Musk has been out previously talking about the environmental impacts. He then was on the B word, stating he has strong support for Bitcoin, and he holds it within on his personal balance sheet, Tesla, as well as SpaceX. Given that China banning mining for Bitcoin, how do you see ESG as a component when investors are considering investing in crypto in general? Like, is that something that, maybe this is better at Daniel or Jeff or Henrik, but like when you guys look at investors, is that on the tip of their tongue and concern, or is it not something?
It's a question they ask, but I think as far as Bitcoin's concerned, which is probably the ultimate proof of work token in terms of its energy consumption, I think it's reasonably easy to answer, because particularly post-China, when you look at Bitcoin's energy consumption, well over half of that energy consumption now is renewable. And almost by definition, it has to be, right? A Bitcoin miner has to pursue the lowest cost energy, and that tends to be surplus renewable energy. So you can't really find any country other than Iceland with a higher renewable rate than Bitcoin, right? So not many industries compare in terms of their renewable footprint. And there's lots of instances where Bitcoin mining is actually solving environmental problems, right? So the flared gas solutions, rather than, you know, burn your carbon monoxide, you mine Bitcoin with it, and it's a, you know, a net environmental positive. I actually think the Bitcoin industry as a whole did a good job in responding to that Elon moment, because a lot of these facts about, you know, just how much energy Bitcoin uses and how much is renewable and what the direction of travel is, and the metrics weren't really understood in the market. So it was a bad moment when he did it, but I'm glad that he did it, because, you know, most of the arguments from the naysayers about power consumption have really been taken away. I mean, Jeff, I know you're across this too. I don't know what you say to your investors on this point, but we don't have much of an issue batting it away, to be honest.
Yeah, I share very similar views with Daniel on this one. Like, you know, the view on energy, on anything, the problem with energy consumption in this day and age is not about criticizing the usage, but really criticizing the production. The world that we run on currently, you know, produces something like 120,000 terawatt hour of energy, and 50,000 terawatt hour energy is just wasted in the form of, you know, wasted, untapped, unsalvageable, you know, stranded energy. And the problem is that how do we solve that problem? How do we solve that 50,000 terawatt hour problem? And just stop focusing on Bitcoin's measly 120 terawatt hour use of that. It's like a fraction of what the big problem the world right now is facing. And also, you know, to criticize the energy use of a innovation without actually weighing the pros reminds me very, you know, there's a Forbes article in 1999 criticizing that the internet uses too much energy and should be shut down. That's a very similar mindset to think about, right? Bitcoin using energy, for those that don't understand it, it is securing the network. It is used to secure your Bitcoin, your holding, and the ones that come before and after that. You know, if you tell me that my bank's vault has more concrete or uses too much concrete, I'm actually happy about it. If you tell me that for ESG reasons, the bank vault is going to be, you know, 50 millimeter thinner or whatever, to save concrete, I'm actually going to be worried, right? If you think about it that way and balance the view out, you can actually see that, you know, look at this way, weigh the pros and cons, and understand it from your point of view. At Monochrome, what we do is that we have a research department that is coming out with content and, you know, to back up, you know, what I just said, essentially to have that educational flow and sort of guiding light in the noise in this cryptoverse to clarify why is something so in this space, and why Bitcoin uses energy might not be a bad thing at all. It might actually be a good thing. And that's kind of the thing that we try to sort of, you know, send the message across to more people, whether they are already invested in Bitcoin or other crypto assets, or haven't yet pulled the trigger.
Jeff, just on that, and talking how you talk to your clients, how do you address volatility of the asset class with your clients versus traditional markets?
Yeah, look, volatility definitely is something that a lot of traditional investment managers or advisors tend to focus a lot of attention on. Given that Bitcoin is a nascent and free market driven asset class, which is going through its early days of price discovery process, you know, the price is by design and nature has to be volatile in its early days in this period of time. You can't engineer stability into a technology that is not supposed to have any central arbiter and couldn't have any central bank sitting on top of it. You know, despite that, we're seeing, you know, institutional players coming to the space. You know, you got even other than our clients, you got even overseas, you got Tesla, PayPal, Square. Even, you know, traditional financial giants like JP Morgan, BNY Mellon, State Street are offering products into the space. And it shows that the demand is there. It shows that the demand is there despite of what people would think of the volatility issue in terms of Bitcoin. You just got to view and price it differently than how you view and how you value other financial assets in your portfolio. It's very important to take a long-term strategy view when you view Bitcoin's price action, because it's such a nascent asset class. It is definitely going to be volatile for the next decades to come, but that's not necessarily the bad thing. If you look at the long-term price action, every 4 years, there's a thing called the halving. Typically, the excitement of the price, rushes before and after those events. And what the halving is the halving of the mining reward every 210,000 blocks, or roughly around 4 years. I think Henrik or Daniel can attest to the performance of Bitcoin as an asset class itself over time, and how volatility has impacted the view, maybe in a good way or bad way. They might be able to shed some more light on that as well.
Yeah, I think one way to approach it is position sizing, right? So that goes for the investors into the digital asset space. So obviously it's a very high volatile asset, but like if you position it right, and I think for most investors we are talking about 1, 2, maybe 3% of their assets in something like crypto that is highly volatile. So I think it comes back to kind of what is the position size you're putting on relative to the volatility of the asset, which I agree will remain high for the medium to long term.
But of course, I think the worst time to invest in Bitcoin will be when it stops being volatile anymore. And so people have got to bear that in mind as well. I agree on the position sizing. Actually, I think that range is exactly what we say to people also. But be glad that it's volatile, because that's where the returns and the performance have come from. And people, I think, on the way in, just condition yourself that along the journey, if you're holding for 5 to 10 years, you're going to have 40 to 50% drops, which sounds extreme to people. But when you look at the overall performance, it easily takes it in its stride. And if you're mentally prepared for that on the way in, that's the way to do it. And, size your stake accordingly.
So John, I want to kind of weigh in on the previous topic a little bit, because I think it's important. In terms of the ESG, there's a component for ESG for underlying assets as well. So things like real estate have ESG component, and we have lots of assets on the SolidBlock marketplace that are rated as ESG, have a ESG certification. So if the funds are looking to increase their participation in ESG product to balance out cryptocurrency or other digital assets that don't have that rating, they have an opportunity to invest in security tokens with the ESG rating. So I think it's one of the things that the crypto world may not be aware of, especially the taxation benefits that come together with this. And I just wanted to make sure that we touch upon that.
And I'd like to add something to that debate as well. I think when you talk about ESG, we always talk about the E, but it's very easy to forget about the S and G, right? There's 3 letters in ESG, and I actually think crypto, score quite well across, E, S, and G, right? So the social aspects, like with the economic freedom that DeFi enables around the world, I think that's something to think about as well. With the governance aspects of crypto networks as well, with the open nature of the networks, and how governance is made in crypto networks. I think that's really interesting aspects as well.
So just back on that, Yael, in relation to tokenized securities and what it could offer, what do you think are the biggest trends in non-crypto, so tokenized assets side of things, FTX, Binance obviously have tokenized stocks, and there's some tokenized commodities, and generally it's just when they're moving, they list them. Do you see that as the future? Like, are we going to see all things tokenized?
Well, unless there will be something new created, right, by the regulators, some new asset class that's between private and public, right, as a kind of retaliation, which I don't foresee that happening, just because regulators are always behind and not in the forefront of the industry. So for now, tokenization is a fantastic opportunity to trade assets without them going public. Part of that was allowed through a regulation in the United States called the Jobs Act, which was created to encourage small businesses by allowing liquidity and peer-to-peer trade of private assets. The other countries followed suit in terms of allowing secondary market, but did not follow suit in terms of solicitation and marketing. So that's what really holding up this industry. When you talk about most digital assets, well, you don't need to do a lot of marketing, for the assets themselves. By exchanges, for example, funds, of course, is a different story, and it costs a lot of money to put one together. So what I think is next really is, the funds industry is really, really interesting. I would like to see tokenization of funds, so that we are able to provide these products also at lower thresholds. And actually, we've been approached by quite a few hedge funds recently. There's still some limitations in terms of tokenization of funds, just because of the sheer number of investors that you can put in each special purpose vehicle. But I think next we're going to see tokenization of hedge funds so that traditional investors can also put some money in. Not traditional, regular accredited and maybe even sometimes retail investors can benefit. And on top of that, as I mentioned, the metaverse is a place where we'll see a lot of trading coming out of all kinds of assets that we have there. And of course, I strongly believe in real estate, just because in real estate, tokenization is a fantastic solution to a real world problem.
Do you have, obviously CBDCs, central bank digital currencies is another one. Obviously the ECB is looking at it. China is, pretty much live with it. US is working with MIT. What do you think the impact is of CBDCs and to the space in general, and how do you see that playing out?
So I can jump into that, or if that's okay, for a minute. So CBDCs, when they came out, a lot of people said, well, crypto's dead, long live, CBDCs, and or even cash is dead, long live CBDC, right? So, and the reality is that it's going to take a long time for the governments to roll them out and regulate them and so on and so forth. And there is space for crypto, which as Henrik said, offers a lot of benefits to people in a way that other assets that are regulated by governments do not, because they cater to everybody's interest. So, but CBDCs are super interesting as an emerging field, and I would be really interested to hear what everybody else here thinks about that.
Sure, I can add to that, Yael. Like if you guys know me, you probably know what's coming. So much of the problem you guys see that people confuse crypto and CBDC, and will CBDC replace crypto or Bitcoin, comes from the fact that it shows that how people don't understand the different innovations or product tranches within the entire cryptoverse. Right, there's so many things in this space that are so distinctly different than the other stuff. Like CBDCs are a complete different beast than Bitcoin, which is a complete different beast than NFTs and DeFi and tokenized real estate. And they all come with their own unique technology, their use cases, and most importantly, their target audiences that sort of backs that adoption and backs that value behind it. So for Bitcoin, digital assets like Bitcoin is on track to be a security base layer or a base layer technology for a lot of decentralized technologies. Similar to how Ethereum provides that speed for programmable, layers on top of it, Bitcoin offers the security aspects of that as a priority. And because of Bitcoin security and predictability, it's a leading role as a long-term investment consideration, as well as a technology base layer. CBDCs, on the other hand, like what I just said, doesn't really even make sense for CBDC because it's completely different. So it's definitely a form of evolvement of, say, digital government money, which is like e-money in our bank accounts. Makes it more, I would say, some people think it's more more controllable by the issuer of the currency. For the user, some people think it's more liberating. Some people think it's more restricting. But the topic that I want to bring back is that we have to, as operators in this space, as leaders in this space, have to start calling for better and clearer labeling in this sector. Everything is so different. Everything is on pros and cons and should be valued on its own merits. The last thing we want is for people to exploit the ambiguity and hurt investors in this space.
Thanks, Jeff. Did you want to add anything on that, Henrik or Daniel?
Yeah, I mean, I think with the central bank digital currencies, really, there's no difference. It's just a new, this is just, my perception is that it's just a new weapon of control for the government, right? You're handing over programmable money to the government. So all manner of different things are now available to them. So, for example, we're going to issue some money, but only to people under 25. We're going to issue some money, but only to particular postcodes. There's all sorts of things that they can do with their programmable digital money, and I can see why it's highly attractive to them. But it still has an unlimited supply. The trajectory of the value of a central bank digital currency is downward, and it will carry on being downward. And likely it will go down faster when it's digital because it's so much easier for the government to manipulate it in whatever direction they want to go. If you look at the situation now around the world, COVID and all the rest of it, if they'd had digital currency to sort of airdrop money into people's wallets a year ago, I think they would have used it much more frantically than they did. So actually from the perspective of what it does to the values in the digital asset space, well, I think scarce assets get more valuable as the tools the government have to issue money become looser, and central bank digital currencies make them looser.
Yeah, I wouldn't forget real-time taxation as well. So obviously they can do real-time money drops, but they can also do real-time tax.
Absolutely, it's a vaguely sinister technology, because at the moment you've got the banking sector in between the issuer and the individual. It's not clear that banking sector will be there. Like, will we all have accounts with the central bank? Like, how's it going to work? It's interesting, but I don't think it means good things for the population at large. But it does mean that the value of currencies is going to fall more quickly.
I think, within our business in TCM, one of the things we're always challenged with is, breaking apart currency, the word cryptocurrency, right? And obviously what the utility is of each underlying token. Bitcoin obviously serves its purpose. A lot of people talk about it as digital gold or a potential, actual currency, right? It's obviously finite supply. But when you go looking at things like Ethereum, and this is probably directed at you, Hendrik, when you talk about your asset allocation and how you decide on what the right investment is, how do you view the intrinsic value of a token and how it will appreciate in value?
Yeah, so I think you're right. So Bitcoin is becoming this digital gold, right? It doesn't necessarily have intrinsic value, but it has a huge potential because something like a store of value like Bitcoin has a very big potential, right? But when you introduce smart contracts, and that's Ethereum, but there's also other blockchains. You have more possibilities what you can do, right? So with Bitcoin, you can transfer value or you can hold value, right? That's pretty much it for Bitcoin. That's a huge use case by itself. But when you introduce smart contracts, you introduce more use cases. And one of those use cases is this new financial infrastructure, which we call decentralized finance or DeFi. So that's one, where we identified as a low-hanging fruit for smart contracts fairly early on. And that has really played out, especially in lending markets like Compound and Aave, these permissionless lending markets, and also in decentralized exchanges. So DEXs like Uniswap and Curve and others, they have seen huge surge in volume. They're around $60 to $80 billion, traded on DEXs now on a monthly basis. So those are some of the kind of sectors within DeFi that have found their product market fit so far. I think the next big wave in DeFi will be something we call on-chain derivatives, so trading futures, options on the blockchain itself. I think that's perhaps the next big wave within DeFi. When it comes to the valuation, you actually have a cash flow on these protocols. So most of these protocols, they have a protocol fee. So they actually collect the cash flow that flows to the governance tokens for these protocols. So you can kind of apply more traditional valuation metrics to the DeFi assets. So I think that's another feature that makes them quite attractive for institutional type of investors, as it is perhaps easier to calculate the fair value of something that generates hundreds of millions of dollars in revenue that some of those protocols are doing today, versus something like Bitcoin where you don't have any really cash flow happening.
And Hendrik, I mean, this is another one which I guess is quite topical, but is USDT Tether. What's your view on USDT? Does it stick around? Is it a systematic risk, or is it all just a bit of fluff?
Yes, it's a great question. So Tether obviously have been the major stablecoin in the market for a long time now. Market share of Tether has gone down recently. So if you look at Ethereum, USDC is pretty much at the same size as Tether now. I think everyone likes to see more alternatives because that's good for the market if we have those alternatives. Tether is still a major pair to Bitcoin and other assets, but we have seen other coins take market share, and I think that's probably positive. We also see a lot of innovation when it comes to decentralized stable coins, so things like DAI, which is backed by ETH and other assets. There are also things like Terra USD, there are SUSD by Synthetics, and other decentralized stablecoins like Frax out there. So there are a lot of alternatives to Tether today. Yes, there are definitely concerns around Tether. On the other hand, they are being more transparent now than they have ever been in the past. So we actually have transparency reports coming from Tether these days. So I think a few years ago, maybe the concerns around Tether was were bigger than they are today for two reasons. One, they are more transparent today than ever been before, and secondly, the market share has been going down lately.
Okay. Yeah, I think I want to add to Henrik's sort of point on Tether as well. Like on a different note, we mentioned volatility in early part of this, the call. Other than sort of allocation strategies when it comes to a volatile asset class, a lot of portfolio managers look at the underlying volatility of that asset, despite even 1%. A lot of traditional portfolio managers take the view that something that is volatile mean that it's bad, but not necessarily, because look at Tether. Tether is the most least volatile asset class, but the risk, the risk of it going to zero is higher than Bitcoin going to zero, frankly. So that's something to think about when we speak about volatility, and Tether is a really good example of that.
Yeah, that's interesting. So our investors, we have a lot of institutional investors on the volatility side, view the volatility as a really capital efficient mechanism, right? So i.e. the amount they need to have allocated to the space, obviously proportionally less to get the same sort of returns they'd get in other assets. So they view it very much as obviously as an alternative, right? It forms part of their portfolio. It's decorrelated with other assets, all this sort of stuff, right? It's, a lot of the time they don't even look at the intrinsic value. They're more considering it from a portfolio composition standpoint. So I do think there is definitely a play there where the volatility is a net positive, not a negative, as you mentioned, Jeff. One thing I want to get onto before we sort of wrap up is the infrastructure bill in the US. Twitter was exploding with, obviously a couple of people sort of trying to push through reforms, obviously to try and rip out the miners and all the software developers on the back of, what would be all encompassing in what got pushed through in the end. What's your view first, maybe, Yael, on how that's played out and whether this is going to be a negative for innovation in the US?
I think that definitely it will have an effect on the market. In terms of the crypto market, I think we've seen that most of these new changes are anticipated by the market, and what I'm worried about is stifling of the industry in the US, right? So I feel like a lot of the industry players may move out of the US, and the US is the biggest financial market in the world for these assets or other assets or traditional assets, like the one we're working, the industry in which we are working with SolidBlock, primarily real estate. So at the same time, what we're doing specifically with SolidBlock can be really helpful to, in some ways, in some cases, defer taxes, for example, right? If the taxation is going to go up steeply for crypto investors, they're actually able to invest in certain opportunity zones in real estate and defer taxes, for example. So we present the opportunity for those investors. Now, the assumption here is that the opportunity zones themselves, that's basically a terminology used in the tax world in the US, that the opportunities will remain, right? Every time there is a big change in the US and the government, we anticipate big change in terms of taxation. And that's the primary driver for innovation and investment in a specific area. So I am personally concerned about those types of advantages, tax advantages, that I hope will stay. There is another term used in the tax world in real estate in the US called 1031 exchange, and we can actually use those to trade digital assets backed by real estate. So if that if that tax advantage will stay, then we'll be able to help the crypto industry even further, right? So I think that the smart investors that will stick it out and find ways to operate will find our industry very, very helpful to them, kind of combining the traditional and the crypto. On the crypto side, on the crypto trading side, on the mining side, I know that you guys here in this conversation are much more knowledgeable, so I'll defer to you.
I mean, I just as far as the US situation goes, I think in politics, right, when it's a toss-up between a conspiracy and a cock-up, it's normally a cock-up, right? And I think they've added legislation in a race at the last minute. And did they intend to capture Bitcoin miners? No, I don't think they did. Did they intend to capture individual custodial wallets? No, I don't think they did. And I think as it works its way through the system, it will come to a more workable solution when it comes out of the other side. So I'm not sure we've seen the final form of the legislation. And I take a lot of comfort from Gensler at the SEC, right? Although he says some negative things, he does understand this sector very deeply. He understands how they work. He's got a clear view on what is and is not a security. And I think ultimately we'll get something sensible. And what happened last week was basically a political balls up that they'll unravel as we go forward.
Yeah, if it improves, that's more regulatory clarity. It's good for US, and trickles down, good for Australia. But if it's something that is impeding, it will just drive innovation out of US, and Australia stands to benefit from it, given that we're such a big hub for innovation in this sector on top of the rest of the world. So we have very similar battles here and at home as well. Like with ASIC's recent CP343 consultation paper, it underlines, how good thing that that consultation paper was pretty well written, from the perspective of a fund manager. I think it covers a few topics and best practices really well. Monochrome, did submit a response to the CP340 paper, which highlights the recent best practices to handle crypto assets in exchange traded products. Because it's no secret that Monochrome is exploring alternative products to our existing Bitcoin fund to provide our client best-in-class treatment, and doesn't exclude the Bitcoin ETF. Because it's really simple. Holding Bitcoin in ETF, it's a simple and familiar way for everyday and institutional investors to gain access to the asset class. within the ETF, you get instant integration with web programs, web platforms, and making the consumer experience smoother. And more importantly, and this is something that a lot of regulators around the world are trying to sort of get it right, which is custody. A Bitcoin ETF shifts that operational and custody risk from unregulated or underregulated managers into to professional issuers and managers. It doesn't just lower the barrier of entry into the asset class, but also make it more robust and ultimately a smoother way for a wider range of investors to introduce Bitcoin and other digital assets into their into a diversified portfolio.
Great, thanks, Jeff, and thanks, Yael and Daniel and Hendrik. It's been great having everybody here. Really appreciate the time. Obviously, COVID lockdown and everything else going on, and the time of the evening, so it's really appreciated. Maybe everyone could just go around the room and tell the audience how they could connect with you or your firm quickly, and then we'll wrap things up. Yael, you want to start?
Sure. So we're SolidBlock. www.solidblock.co. You can find me anywhere on social media. I love connecting to people on LinkedIn, Yael Tamar, or on Twitter at Yael Tamar. I'm happy to talk to anybody who'd love to explore tokenization.
Daniel?
Yeah, you can find us listedreserve.com. We're on LinkedIn, Twitter, all the usual social places as well. We've got an office on Gloucester Street in Sydney for those people based in New South Wales. Do come and say hello.
Great, thanks. Jeff?
Yeah, you can find us at monochrome.co. So it's just, there you go. Monochrome.co. So you can drop us a email inquiry, or you can visit our office at Central Plaza here in Brisbane. Maybe even give the racing sim a go. It's a F1 cockpit for you to try on, whoever wants to visit the office. Big F1 fans here. Yeah, we look forward to hearing from you.
Thanks, Jeff. Hendrik, sorry.
Yeah, so we are on apolloCap.io and Twitter, LinkedIn, etc. We are based in Melbourne, but we have people in Sydney as well.
Great. Well, thanks again. I'm John Dean, as mentioned, from TCM.Capital, and thanks to the audience for listening in, and hopefully catch up again soon. Thanks, guys.
All right, thanks,
Thank you.
everybody.
All right, thanks. Bye-bye.